All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. Today I'm digging deep into the Double Play archives again, and I'm resurrecting a video from July of 2021. So throughout this video I'm going to be interjecting a few times just to bring things up to the current time frame from where rates were back then. But in any case, today we're going to be talking about dividend and interest crediting rates and whether or not they're comparable. So this is important because people are always asking the question of, which one is better? Which one can I expect higher returns from? And in this video, I'm going to dive into the mechanics behind the policy, how the rates are determined. And if that's of interest to you, then be sure to stick around after the intro and I'll break it all down. All right, thanks for sticking around. I'm Tomrutkowski, life insurance guru with innovative retirement strategies. I came up with the concept of the double play many years ago on my own when I discovered that I could build a maximum cash value policy with about 85% of the cash of the premium going to the cash value of the account. I ran the numbers and proved it out, and it proved that you make more money by leveraging the cash value and putting your money to work in two places at one time. So I made it my mission to communicate this to the world because I thought it was so powerful. But many people have a negative opinion of life insurance, so the goal of this channel is to demystify life insurance and break down all the myths and misconceptions that people have, as well as answer the questions that people have about life insurance products. So today we're going to be talking about dividend rates and interest crediting rates, and are they comparable? So before we can do that, I've got to cover a little bit of housekeeping items. Mainly, the purpose of life insurance is for the death benefit protection. Any other use, like the double play, is purely ancillary. In addition, there's no advice being given in this presentation. It's all educational. So no financial advice, no tax advice, no legal advice. Also, if you find my content valuable, please be sure to like and subscribe so that you're notified whenever I come out with new videos. All right, so the goal of this presentation is to show that the differences in methodology may result in different rates, but the overall return on policies is going to be roughly the same. Both whole life dividends and IUL crediting rates represent the allocation of insurance company investment gains from their reserves to individual policies in the form of cash value. All right, as is usually the case in my videos, I like to start off with what I call a life insurance 101 discussion. And the reason for that is that most of the questions that I answer in these videos, the answers can be found in a basic understanding of how life insurance works. So once again, I'm going to start with life insurance 101 and cover the basics around cash value and dividends. And then we're going to apply that to the question. And finally, I'm going to go over some of the takeaway items, what I think you should really be focusing on instead of the dividend or interest crediting rates that are being used. So, all right, let's get started with a little bit of life insurance 101. I want you to have a good understanding of what the cash value in a life insurance policy represents and what the dividends and interest credits really are. We'll talk a little bit about life insurance guarantees, and then I want to take a macro view from the insurance company's perspective. And it'd be helpful to understand what the cash value is if we take a look at my usual graph of a minimally funded life insurance policy. So let's take a look at that. In this graph, we've got a 45-year-old insured with a life insurance policy with a death benefit of $1 million. And there's basically two components of a life insurance premium. One is the contribution towards basically the policy owner saving up the death benefit for the insured over the insured's life expectancy. And that's the blue line represented in this graph. So with each premium that the policy owner pays, some part of that goes towards the policy owner saving up the death benefit. And basically that's just a risk transfer over between the policy owner and the insured. Just as with term insurance, you need the death benefit protection in the early years when it would be very damaging if the insured died. But over time, basically, you're setting aside money so that by the time that person reaches their life expectancy, you would have saved up the money to pay the death benefit anyway. So the risk is transferred from the insurance company in the beginning to you in the end. Now let's get back to the graph again. So that money does not sit idle. The insurance company is investing it. So insurance companies typically invest in safe, secure debt instruments. So bonds, treasuries, preferred stocks. They buy plenty of mortgage-backed securities off of banks. They make loans on real estate. So basically at the end of the year, they have income, all interest income from all those investments that they have. And that income is allocated to each of the policies based on the contribution of each policy owner. So that's the gain. That's you saving up your money with the insurance company basically investing it as safely as possible, but trying to maximize the returns as well. So let's briefly talk about the second component of the policy. So if you look at age 45, for example, if you look at the orange line, you can see that the death benefit is $1 million. So at that time, you've got very little cash value saved up, so most of the risk is on the insurance company. So if you were an insurance company, you could basically go out and purchase reinsurance, a one-year term policy on a 45-year-old for $1 million, and that would cover that insured. Or basically, really, you'd need about $999,000 because the first year's cash value would account for that last remaining $1,000. And then over time, if we look out towards age 79, for example, you can see that the cash value has grown to about $500,000. Now here, the net risk to the insurance company is the balance, the delta or difference between $1 million and the $500,000 of cash value that's been saved up. So it's important to understand that the cash value is part of the death benefit. It's not a separate savings account. It's part of the life insurance policy's death benefit. But the risk goes down over time. So you can see that there are a lot of assumptions that go on in a life insurance policy. What rate is the cash value going to grow at? If you look at that curve, if I change the interest rates that were used, that curve is either going to increase in slope and reach that $1 million sooner, or if I use a lower interest rate, it's going to reduce the steepness of the curve and it's going to intersect with the $1 million later on. So insurance companies are heavily regulated at the state level to make sure that they can pay their claims. So the insurance companies have to price out their products using some worst case rate of growth to make sure that at the bare minimum, assuming the worst market conditions, that they can perform on the obligations of that policy. And the money that they have to set aside into the reserves is what we think of as the guaranteed rates in a whole life product. Basically, they've got money sitting aside according to the rules set up by the regulators to make sure that they can pay all of their existing claims at that time. And whether it's whole life or whether it's index universal life, all insurance companies basically have the same amount of money sitting aside in order to pay those claims. Now, in the real world, the insurance companies may or may not make the guaranteed rate. If we look at the last 30 years ago, interest rates were very high, 7 or 8% back in the 90s, early 90s, and they've been steadily falling ever since. So for a long time, insurance companies were making well in excess of what they needed to put aside into the reserves to make sure that they pay all their claims. So all of that excess is basically credited to the life insurance policies, in addition to what they need to set aside to maintain the minimum reserve requirement. And that's really what the dividends are. It's that allocation of the insurance company gains on their investments to the individual policies based on the relative cash value of each policy. So you can think of it as the return on the cash value portion of the policy. And it's important to understand it's not the return on premium, it's the return on the cash value portion, what's left after all the fees are taken out. All right, so that was the view from the 10,000 foot view. It was relatively simplistic. What I want to do now is come a little bit closer down to the ground and cover a little bit more of the detail, what really goes on under the hood. Because there's a lot of moving parts in a life insurance policy. It's not just an allocation of the gains. If you think about it, each year they're adding, who knows, hundreds of thousands or millions of new clients, all paying new premium that goes into the reserves. And at the same time, you've got the gains on their investment holdings. You've got all the death benefit claims that have to be paid. And then you've got the cost of setting aside the money to pay the claims. And finally, at the end of the year, you've got money left over. So some amount of that goes into the reserves, and that's basically the guaranteed portion of the dividend. And then any excess is what's the investment portion of the dividend, the excess or the allocation of what's called the divisible surplus. So as we're looking at this, you can see that there's a number of different line items in there. There's the new premium dollars coming in, the investment returns, the claims that they have to pay, and then the amount of money that they need to set aside for mortality costs. And when they're calculating dividends, it makes a big difference on where these costs go. So some companies don't include the mortality costs and the policy expenses in the dividend calculation. They account for it separately. So these companies might show a higher dividend that's credited to the policy, but as a separate line item, they then subtract out the mortality costs and policy fees. Whereas other companies might bake it all in and just show a dividend crediting. So you're going to see two different rates from different insurance companies, and this is on the whole life side, mind you, not the index universal or universal life side. All right, so let's spend a few minutes talking about interest crediting on the IUL side. So with index universal life policies, they don't pay dividends. They basically take that investment gain, that same money that would have been paid out as a dividend, and they take that money over to the index options markets. So the S&P 500, the Russell 2000, different stock market indices. And the goal of their hedging activities is to try and capture as much movement in the market as they can get with the money that they have to spend. So they buy options with as high strike price as they can get. And basically, if the indices go up to that point, then you can capture that strike price. And that's basically what the cap is on an index universal life. By the same token, if the market indices go down, then you could buy into the index at a lower price anyway. So the options expire worthless, and that's the floor of zero. So in an index universal life, there is no set amount that is credited each year. It's either zero, or it's up to the cap, or anywhere in between. So when you see an interest crediting rate used in a projection, it's basically just a forward-looking projection based on an application of the current cap rates to the historical market data to show what would that policy have performed or looked like if this cap had been in place for the last 30 years. Now, given that interest rates are much, much lower right now compared to what they were over the last 30 years, I would expect that interest crediting rate projections used on IULs are actually very low or conservative today compared to the dividend rates on whole life policies. So let's go down a separate rabbit hole now and look at the dividend rates used in whole life policies. So if you look, there's a couple of companies out there right now that are paying 6% dividends. Penn Mutual, I think, is still over 6. Mass Mutual, I think, is at 6.2. Keep in mind the Moody's corporate bond yield right now is under 3%. So I would ask you, question, where is the company investing its money that they're earning a 6% return on their cash value when all the new money going to the policy is likely earning under 3%? So the dilemma here, and this is true again for both whole life and index universal life, the insurance company has a lot of existing holdings that they've held for many years, and these may have a higher return than any new money that they're currently investing. So as time goes on, all of the new money is basically whittling down the average returns on the cash value. So you've seen this you've seen dividend rates following interest rates declining over the last few years, but still staying a little bit above. But I think if interest rates turn around and start going back up again, you still may see the dividend rates on whole life policies continue to decline until they find equilibrium again, and all the new money going in makes up for and starts to increase the base of all the old money in the policy. And with index universal life, the interest income on the reserves is what sets the budget for how much they can spend in options. So even there, as interest rates begin to go back up again, you still may see caps staying low until the overall return of the overall reserves starts to go back up again. But I would again expect that because of all the old money sitting in the policy, along with the new money, you may still see the amount able to be spent on hedging activities to go down. All right, so I said all of that, and I gave you an idea of how the dividends are calculated, that they may or may not be apples to apples. So what's the real point that I want you to take away from this presentation? So since the insurance company has an incentive to maximize the return on their cash values, given all their liabilities, all else being equal, we should expect that the performance of the policies to be the same despite differences in the dividend rates. So we have the expenses, and they have to be accounted for somewhere. So whether they're net or gross in the dividend calculation, they've still got to be applied somewhere. And what I really want you to understand is that the insurance company is incented. The faster that cash value grows, the quicker their risk is eliminated. They don't have to buy as much insurance in the reinsurance market or set aside money in a pool in order to pay all the claims that they have, because the cash value is going to make up the difference. So the insurance company has an incentive to grow the cash value as fast as possible. So whether rates are gross or net, what's really important is that you use a forward-looking rate that reflects how that cash value is actually going to perform over the next few years. And I would argue that using a rate like 6.2% to project forward from today when rates are so low, you're setting yourself up for disappointment, because those dividend rates may continue to decline even as interest rates in the market start to go back up again. And you need to pick a rate that's forward-looking. On the IUL side, there's two forces at play. As interest rates go back up again, the insurance company will have more money to spend, and it can buy more movement in the market, and the caps will adjust quickly. But that budget that they have to spend on options may not go back up in sync with the change in interest rates as quickly as we would hope. So the main thing here is just forget about the dividend rates and just think about what rate you want to use looking forward. The agent can plug in whatever you want. And then understand the mechanics of the policy, that the insurance company is investing in safe, secure debt instruments. Again, treasuries, bonds, preferred stocks, mortgage-backed securities. And just understand the mechanics of the policy so that you're not disappointed when the economy changes and interest rates change, and things don't look exactly like they did on the piece of paper that you looked at 3 or 4 years ago. So again, determine the rate that you want to use for forward-looking projections. Today's rates are not representative for the next 30 years. Just think back over the last 30 years what rates have done. Again, back in the 90s, interest rates were much higher and dividend rates were much higher on the policies. But over time, those rates have gone down. Think about how the dividend compares to the Moody's corporate bond yield. Is it very high, like it is today? Think about what you think interest rates are going to do, and how you want that company's policy illustrations to be done. All right, and finally, all else being equal, the cash value of an indexed universal life will exceed the debt market return because of the hedging. So we can expect slightly better performance out of an IUL's cash value than what we can out of a whole life. So one unique thing there is, you've often heard that rising mortality cost is going to cause an IUL to lapse. Well, the reality is if the cash value grows faster, there's even less risk in an indexed universal life. So it's really a safer product when it comes right down to it. Does it have the guarantees that a whole life has? No. But in the real world, when you look at the mechanics and understand the mechanics and how it works, the policy will perform better. All right, and wrapping things up, dividend and interest crediting rates may not be apples to apples due to differences in the method used to calculate dividends between whole life products. Some include the mortality cost in the calculation of divisible surplus, and others do not. And more specifically, IUL and UL products do not. And then remember that today's dividend represents current conditions. This rate may not be suitable for forward-looking projections. All right, so with that, I'm done. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I highly recommend going out to Facebook and look for the Double Play group. And this group is a community of people who are doing the double play themselves, or just people interested in learning about the double play. So you're free to go there, join, ask questions of the membership to get the answers that you want. If if you don't want to get on the phone with a life insurance agent who's going to twist your arm and try to sell you. So I consider my website to be a no fluff zone. I've got tons of information on life insurance and the double play. I've got blog posts that correspond to each of the webinars that I do, and then each of those webinars eventually turns into a YouTube video that I post up on YouTube. So if you want more content than what I have here on the YouTube channel, be sure to go to my webpage and check out the recorded webinars, which are far and ahead of where I am in producing these videos. And then again, if you prefer to read to get your information, the same content is available in blog form. So again, if you want a copy of the slides used in this presentation are going to be available in a link that I put down in the description. And while you're down there, be sure to like and subscribe. And I look forward to seeing you in about a month or so when I get the next video up.
So I'm going to stick my nose back in here one more time. If anybody's been curious about the changing backgrounds over the last series of videos that I've released, just wanted to give you an update. I rented out my condominium back in Boynton Beach for the tourist season, and I've been taking that extra money and using it to travel around and see what's in Florida. Next week I'm off to Vegas and just enjoying life. So if anybody's curious, that's the reason for the changing backgrounds. Hope to see you in the next video.